Welcome to the Political Risk Podcast, where geopolitics and insurance markets meet. I'm your host, David Benyon, and I'm joined by three guests for a webinar that I recently hosted for Global Reinsurance on the conflict in the Middle East and its effects on the political violence insurance business. Three guests are Sandy Warne, active underwriter at Sukoon, Daniel Callow, lead underwriter for political violence and war at Starr, and Cosmo Warne, Director for War, Terrorism and Political Violence at Forbes. With thanks to my friends at Global Reinsurance, this conversation will be an edited down audio version of that conversation. I'll include a link to the original webinar, which was titled Reinsurance in a Time of Escalating Tension, in the episode blurb. A brief introduction to the three panellists. Dan Callow is head of PV and War at Starr, previously lead underwriter for PV and War at IQ Underwriting for 5 years. He has worked in the market for nearly 20 years in London and New York and is a member of the LMA Terrorism Committee and the Aviation War Subcommittee. Sandy Warne is active underwriter at Sukoon. She brings nearly 25 years of experience in the insurance and reinsurance markets, with a career spanning specialty lines, insurance broking, underwriting and reinsurance broking. Cosmo Warne, Director for War, Terrorism and Political Violence at Forbes. Cosmo leads the broker's international portfolio and specialises in structuring and placing complex terrorism and political violence programmes across both London and regional markets. And for one moment wearing my other hat as the editor of Global Re, a reminder to secure your place at the inaugural DWIC Connect event, taking place at the Chirahan Palace, Kempinski, Istanbul on the 7th of July. DWIC, the big Middle East reinsurance event hosted by Global Re in Dubai each year, has been postponed to December due to the ongoing hostilities in the Gulf. So until then, DWIC Connect in Turkey provides a great venue at a critical time to bring together senior reinsurance leaders, keeping the industry connected precisely when it matters most. Okay, let's get into the conversation and join the panellists. Clearly, political violence is in the eye of the storm in terms of straight-out underwriting losses rather than sort of second-order supply chain disruption, that kind of thing. Probably along with marine war, this political violence PV is really the core of what we've seen. So I'll start with Dan and then Cosmo and Sandy. But in summary terms, what has happened to the PV market since the end of February, and how would you characterize the scale of what we've seen?
So since the 28th of February, when the US and Israel started striking Iran, we've seen sort of sustained missile and drone activity. It's led to widespread airspace closures, lots of attacks on critical infrastructure, and obviously attacks in the Strait of Hormuz as well. So in terms of impact to the market, it's been very, very significant. Political violence losses are starting to come through in the market. I think this is probably going to be a defining event for the PV market and probably generate the largest sort of insured losses that we've seen in the last 20 years.
Dan has summed it up in a nutshell pretty nicely. I mean, from a broking perspective, it's been fascinating to see the crystallization, I think, slowly but steadily, of the severity of the last few weeks. Losses are slowly becoming apparent, obviously not disclosing any client names, but certainly major clients that are buying the product in the market have seen the value and the importance of buying the coverage. It's becoming more and more apparent. Some of these losses are on an individual basis. We've had a couple that have been not far off the total sum or estimated amount from the Ukrainian conflict. One major energy asset in the region is expecting, a full limit loss of up to $800 million. So as Dan rightly pointed out, I mean, the severity is becoming more and more apparent. And I think it's going to be quite a bit more significant, I think, than what we experienced from just, say, Ukrainian conflict. So from a broking perspective, we've been running around like headless chickens. The market has had to react pretty quickly in terms of trying to get its head around what these losses might look like and setting aside the correct reserves. So as a result, we've seen rates flying all over the shop in different areas as people seek their appropriate rate for their capacity. So been certainly a busy time from a broking perspective, finding solutions for clients whilst also trying to handle the claims at the same time. So busy times.
Just to pick up on what Cosmo said, when you look at the numbers and the fact that there's been more physical and financial loss estimated in 3 weeks than there has been in 3 years of Russia-Ukraine, I think the word I really use and focus on is unprecedented. And having the sort of the bonus of being on the ground in Dubai, and we talk about what we have seen in the market, there are things I have physically seen that might have been reported, in the press. And so that really gives me a different dynamic in terms of what you're seeing from an underwriting approach is this real sort of moment of panic in the market, of some markets putting pens down. There's been a real disproportionate response from those in region versus those in London. My personal view is the sort of the underwriting approach has been very much affected by the international press, because there is a real spectrum of how people are perceiving risk for the right reasons, but it's just never been considered. Certainly nobody ever thought there would be this level of physical attack coming into the UAE, which is going to dictate a number of the topics we're going to touch on in terms of coverage. But I definitely would say that unprecedented is the word I would use from an underwriting perspective in region.
Cosmo, I'll turn to you next. So looking across the Gulf states, we've already seen, some of this has been reported on in the media already, loss notifications coming in, claims activity, and you already referred to one big example of that already, but anonymizing as necessary. Could you just give a little bit of a rundown of some of those examples we've seen?
Yeah, absolutely. I mean, the most obvious one, which is, very much in the public eye that everyone's fully aware of, is, of course, the strategic targets that Iran and the US have both been going after. So, of course, the energy sector, the most significant losses that the market are seeing or experiencing all fall into the energy sector. And it's been, certainly from a coverage perspective, seeing the limits that some of these client types have been purchasing historically. As I mentioned, that one client that I mentioned just now, which is up to an $800 million expected loss, seeing the scale of these losses and actually the historic rates that they were paying for the product and what they're actually now facing on the back of it, it's going to be quite a severe adjustment. I mentioned that one client, which was 800 million. We have another couple of a similar nature, both energy assets in Bahrain and then in Saudi. And of course, we have a couple in Iraq as well that have also been struck. Quantum's, 800 mil I mentioned. We have others which had reinstated limits of 350 million. So double that, 700 million. I think, again, as Sandy touched on, the total loss amounts is looking to be at about $3 to $3.5 billion worth of total losses. So to give that some further perspective, the global terrorism market generates probably about $1 to $1.5 billion worth of written premium on an annual basis. So you're looking at underwriting portfolios, running at sort of 300%, which is really quite a severe outlook really into what's been going on. So some major losses, some that on their own have outweighed or certainly close to outweighing the actual impact from the overall Ukrainian piece. And I think certainly still some more to come, as there have been, there's certainly still some claims that are being reviewed from a coverage perspective, the disparity between whether the terrorism policies are going to pick them up or whether they're going to be war coverage that should be responding.
Dan, turning to you, how do those losses compare to just the annual premium base? I think it might be a different figure, but Cosmo already mentioned terrorism. Is that the same question again, or for the global PV market?
Cosmo's number, that sort of $1.5 billion gross written premium, is sort of where we sort of pitch the total market. So, like Cosmo said, we've far exceeded that most likely. And obviously, there's a lot more of the year to get through. So this has to be a turning point for the market, because at those levels, it doesn't work.
Sorry, separate to the energy infrastructure, it's gone much further in region. And I think this is where it is that turning point that Dan was talking about, because you could always argue that energy infrastructures have been, a higher risk or potential target, on a single location basis. But what you've also seen is the ports and terminals, airplane terminals potentially targeted. Couldn't possibly comment having been evacuated from one. But, it's wider than that sort of energy infrastructure, and it's hotels. Now, whether that's on the back of falling debris, it becomes very specific in terms of some of the potential, you could say, targets that have been hit either directly or indirectly. And I think that's what's sort of extending out that loss notification, certainly again in region from falling debris. There's even been losses on motor policies. And again, this shows that this is a different type of warfare and a real sort of defining moment for the line of business, because it's not just that energy infrastructure anymore. It could be multiple assets in region. So,
geopolitical instability, is that, compounding aspects of these losses?
I think it's definitely going to compound it, because when you look at that geopolitical instability, for me, it's very much threefold. You're going to have a pure regional focus here, where you're looking at the ongoing proxy. So, what's going to happen in the maritime shipping lanes. And, as Dan touched on, from a broader portfolio perspective, we have aviation war and marine war and terror. It's something we'll get onto later in terms of reinsurance, but it doesn't just become about PV. The war classes can touch on multiple lines of business, especially looking at cargo, war on land. So you've got a regional threat of the ongoing activity with Iraq, Lebanon, Yemen, Red Sea. That's showing no signs of ending anytime soon. You then overlay an economic perspective where you look at, the damage to the energy assets and what's that going to do for inflation. And we've seen in other losses in prior years what inflation can do for civil unrest and other political violence and war perils and the effect that can have. And then you've got a global outlook of what does this look like in terms of the US and China and Russia all coming together now? Does this change the chess pieces on the board? So it becomes sort of a regional security issue, a global, a maritime, a global power rivalry, and it's almost that increased militarization across the board. So the ripple effect is far beyond what's going on in Dubai, in region, and in the UAE. And I think that's going to be the sort of the defining point in time for the line of business and for all war lines across the board.
Let's zoom in a little bit further and talk about wordings, coverage, and claims. So, Cosmo, I'll turn to you next. If a client has purchased, this has happened, standalone terrorism policy, so not a comprehensive PV policy, is that likely to trigger a claim? Can you walk us through a practical example of where, this has happened and it's either will or will not respond?
Yeah, this is a massive topic of conversation at the moment. So we've seen this in various different nuances over the years in different sectors and different areas of the world. But I think certainly the escalated conflict in Gaza and the question marks surrounding whether or not a terror policy should be responding, the involvement of Hamas as a terrorist organization, Hezbollah, etc. The nuances behind whether terror policies should be responding or whether the war policies should be responding have led to actually very, very costly situations for clients who actually haven't been buying the appropriate cover. Certainly from a market perspective and as a broker, we would always, for all of our clients in these regions, the suggestion of ensuring you're buying that full scope of full political violence that includes that war aspect. It doesn't just remove the grey area of any dispute, but it also, any cost savings that the client might be making by making shortcuts and buying standard S&T to be able to make a bit of an upfront saving on the premium can actually really come back to bite them quite significantly down the line when actually that saving is actually going towards court and legal costs rather than actually just an upfront premium that gets you that sleep easy, full scope of cover in the region. So look, Dave, in answer to your question, would a standard terror policy respond? At the moment, I'd like to hear Dan and Sandy's response from the underwriting side as well. But the short answer is that a lot of the disputes are in court at the moment. Sandy mentioned infrastructure in the UAE. No names mentioned, but certain clients of that type have bought just S&T cover and are facing that exact problem at the moment. They are trying to claim under the policy, but underwriters are pushing back that actually, no, this is a war, this is state involvement.
Yeah, it's certainly not sabotage, and it's certainly not a non-state terrorist act.
And I think I mentioned the saving that people are making up front, but certainly there are, again, no names mentioned, but there are clients who, one rings a bell, which made a saving of $15,000 up front on the premium because they wanted to cut corners and decided actually, we'll just risk it, take the terror policy rather than full PV. And lo and behold, their assets were struck and are looking at a full $18 million uninsured loss that would have otherwise been covered under a full PV policy. We had a client who'd been buying PV cover for years and years, a Qatari client, been buying it, big full value limits, and they ended up non-renewing last year, thought they'd make a saving on it. They deemed the product not worthy. And then lo and behold, this year, assets in Qatar were being hit and they came charging straight back in. And we quoted the exact same structure, exact same asset type. And it was a 3,000% rate increase on what they'd been seeing previously.
Wow.
So until the product's properly tested, clients can sometimes see it as a bit of a nice to have product. But actually, I think the severity of these losses are proving, never more pertinently has the product been so valuable. And certainly that getting it now or getting it historically when it was cheaper and getting yourselves on the books has proven incredibly valuable.
I think often there's been an issue for certain clients where they've had a lender's requirement to buy terrorism insurance. And so that's been enough for them to cover what they need rather than actually buying the full product that's applicable to the area of the world that they're in. Yeah, up until this event happened, buying full political violence coverage in the region was very accessible. The price point was very good. There was lots of capacity available. Obviously, that's changed significantly. Going back to the point around the coverage, I would expect all clients have had the option to buy full political violence cover from their brokers because all the brokers will have canvassed the market to get clients what they think is the appropriate cover. So, this is very much a war event. Iran, it is a country, it's a state that's acting. So this is a war. When states are firing at each other, that is a war event. Obviously, clients that have only purchased terrorism are in a tricky situation. And yeah, we have seen or been made aware of clients trying to claim on the terror policy. But from our view, it's clear that it's a war event. There will be questions about law and jurisdictions. I think anything that was on England and Wales law would be quite clear that it's a war event. But perhaps some jurisdictions will be tested. But I think there's plenty of evidence to show that this is a war event and should be covered on that basis, or not covered, depending on the coverage bought.
And I think Dan makes a great point. It's something I always ask of my underwriters is, talk me through your local expertise when it comes to regional law and jurisdiction. If you have an England and Wales, you're pretty tight on your wordings, but the interpretation of local law and jurisdiction, you'll put in the hands of a very different set of standards. And I think one of the things that you might see coming out of this event is if there was maybe pressure put onto maybe regional reinsurers to be seen to be honouring claims because, they want to be seen to be providing insurance to businesses. And that's something that could change going forward. It's a similar instance in the marine war world around notice of cancellations. Are governments potentially going to put pressure on that you can't issue a notice of cancellation because that wouldn't be deemed in good spirit of an event that's ongoing? Now, the argument to that would be, well, that's best practice under international terms because you have a rate and then the rate is increased in response to a regional situation. So I think that's just something, to Dan's point, to stress the importance of understanding the law and jurisdiction you're writing either an insurance or a reinsurance policy on, because that's where you could very clearly get unstuck with terms and conditions and a DIC, DIL type approach.
The thing that we don't want as insurers either is we don't want to be debating whether a claim's valid or not. If you buy the right product, it will get paid. The clients in the market that have bought full political violence coverage and have sustained losses, they will get their money very easily and it'll be straightforward. So that's why we always say, buy the right cover. No one wants to go to court to debate whether it was a terrorism event or war event. Buy the full cover and there's no dispute and you get your money.
There's another question I wanted to stick with Sandy for a second. Are we seeing any tension between, Sandy, you're a former reinsurance broker, at treaty reinsurance level so far? Or, is there alignment, so to speak?
I think one of the challenges we face as a market that is very much reactionary rather than proactive is you don't necessarily have the data sets. These events are very, high frequency, low severity. So what you typically see, which can be very frustrating for the underwriters, is the reinsurance market will be a bit jittery, or they'll shift their event definition, or they'll shift their appetite around SRCC. It won't necessarily be a blast zone, it'll be a country. And now it could be a regional. And I think that the regional conflict approach, which will be a challenge to everyone potentially from 1/7, let alone at 1/1 next year, because I think that's where you might see, there were slightly different terms and conditions put out by certain reinsurers looking to maybe give you a more competitive package already seen last year. Are they going to respond in the same way a traditional reinsurance package would have worked around reinstatement, be it in country of loss, or reinstatement in same country, but a separate event definition around the days? And I think that's where we'll all have to essentially sit and wait to see what reinsurers will do, because you've had country conflict before. We saw that with Russia-Ukraine. That was the first time people were sort of really envisaging you could have multiple losses ongoing with separate occurrences that would reinstate your net appetite. But suddenly to have that in a regional definition could leave a lot of insurers exposed with multiple events sitting outside a potential 30-day window, multiple net reinstatement. And then you have to factor in your reinsurance reinstatement. How many reinstatements have you got? Have you got that sideways cover? Or are you fully reloading with your reinsurance premiums, your reinstatement costs, and you're taking another net loss on a country by country basis, which again, people haven't necessarily modelled and baked into their reinsurance purchasing. So I think the reinsurance could end up being a bit of a tail wagging a dog to further compound the hardening of the market, because as we stand right now, and as Cosmo and Dan have touched on, this is an event that is really affecting everyone. Markets aren't coming out unscathed, which is what has happened certainly in, Arab Spring, in the Thai riots, even in the South African riots or the Chilean riots. You had much more of a split between the all risk and the terror market. This is a real event that is hitting the terrorism market in its entirety. So I think the reinsurance will further compound that hardening as we move on in the year. As Dan said, we're only in April and we've already well wiped out the GWP for the marketplace.
Another area that I suspect is going to be a giant question mark, but certainly when we were planning this conversation, I know Cosmo wanted me to raise, we already touched on it, occurrence clauses, event definitions. It is a big area of uncertainty.
I think the great thing about our marketplace, and I do come back to, again, picking up what Dan said, you have the right coverage. We want to pay claims. That's our first and foremost. The product evolves in a way that I feel very proud of, having been a direct sort of underwriter for over 20 years in the line of business. But it's going to come down to your net appetite of your company. There's going to be no one approach fits all. There are people who've really lent in the same way that there's markets who've put the pens down. There's people who will look at this as an opportunity to provide further stability and leadership. And there's others that will sit there and say, we don't have the GWP to pay another reinstatement and take another net loss. So I think it's going to be very, again, reactionary, depending on the balance sheet of the underwriter in question and their appetite for risk. Dan, I don't know what your thoughts are on that.
I agree with you, Sandy, with what you said. I think the interesting thing is we're already now, albeit there is a ceasefire in place, we're coming up to effectively the second event, right? Most war policies have a 30-day event definition. So we're now 2 in. So, obviously all reinsurance contracts will be slightly different for each insurer, but more often than not, it's wider than a 30-day occurrence clause. So people are coming up to a third event already potentially. So it's going to be a real test of all the scenario planning that each underwriting company does, whether they've got it right or wrong, or the analysis that they've put in place makes sense. I would imagine that as we get closer to the end of the year and when a lot of reinsurance contracts come up for renewal, there's going to be a lot of discussion around, are we buying the right product from a reinsurance perspective? This is the true test now, and we're seeing it, and whether things work as we would have thought.
Sticking with this reinsurance treaty level, we've already heard that the losses we've seen have effectively wiped out years of PV gross written premium. It's not isolated cases. It is, these losses are spread around the market. Well, I guess what I'm always interested in is if there's a massive disjunct in terms of the way that the treaty reinsurance market is in its very soft market cycle at the moment. And yet we have this almost anomaly in PV business where there's such pressure now at DNF level before it reaches reinsurance market. It's certainly a hard market for PV. And I'm just curious what that will mean in terms of capacity and pricing at reinsurance level, whether maybe PV can still be lumped in with some other lines of specialty business, or whether it's be pushed to be separated out entirely, how reinsurers will treat that. I know it's going to depend on dates in the future. So, whether it could be 1/1 next year, but what we can say at this point.
I can jump in on that one. And I think one of the challenges, to your point, David, will be it's commonly referred to as MET. It's marine, energy and terror. And, you could argue right now all three are getting tanked. This isn't just an isolated terror event. The marine markets had losses. People will buy a marine and terror program. People will buy a marine energy and terror program. So no one part of the reinsurance programs are going to go unscathed either, or you can't say sort of 2 of your 3 pillars haven't been touched. And so I think for a number of years, the PV has been tried to be sort of forced in, or at least put into sort of a bouquet of reinsurance products, the smaller scale, the less volatility, or it's made money in the past. Whereas I think because this will bring in the losses on the energy side, you've seen marine war losses and terror war losses, but you weren't necessarily seeing the energy losses coming in. And again, you then have to look at the language of whether there's more exclusions under the energy policies or whether it's a generic or risk policy. So I think at this point, it will certainly make reinsurers look harder, because you are seeing more larger scale events that involve the PV outside of region as well. This is now the next big thing on the back of people still looking at that potential for China, Taiwan. It's not like you can look forward and think that there's a clear path. The world is definitely getting more unstable rather than stable, isn't it?
Let's talk about Russia-Ukraine for a moment. I'll turn to Dan for a comment on this as well, because, as it's already been said, we've seen bigger losses in the last 3 months than we've seen in 3 years of Russia-Ukraine. And we saw, the RUB exclusion, the Russia-Ukraine Belarus exclusion. We haven't seen anything like that so far being talked about, at least I haven't, from the reinsurance market for this conflict, even though the numbers involved are bigger. So let's address that.
There's a couple of bits there. So one of them would be that with Russia particularly, there were sanctions in place. So the market couldn't trade with Russia because of sanctions. So that took them out. So the reason for having that endorsement on a lot of policies is to prevent any sanctions issues. Again, one of the things that we saw from reinsurance contracts post the event was quite significantly differing retentions that were being offered. So a lot of syndicates would either take a much bigger retention or had to start with a much bigger retention because reinsurers wouldn't come down so low. And also we were seeing much more specific policies in place and less composite. Composites come back a little bit in the last couple of years, and it just depends at what level the composite layers kick in at, I would imagine. Because, like I said before, like if we're going into a third event now, if you've got a large net retention and you're now going into your third event, you might not necessarily be into the program or significantly through the program. I think there's a lot of things that we won't find out until probably later in the year as losses crystallize across the market. But yeah, Russia-Ukraine did change a lot from the reinsurance market, but it was probably more around pricing, retention, specific coverage. I think in terms of the Middle East, although the losses are bigger, there's no sanctions issues. Insurers will look to deploy capacity into the region if they think it's the right risk at the right terms and conditions. And I think if there's a good underwriting strategy around it, I would still expect reinsurers to support that going forward. What you would likely expect is that the total aggregate that's deployed by the market in the region is going to be significantly less. We've had some estimates from people about each country in that region and the aggregate that was deployed, and it's huge. That won't be sustainable going forward. It's going to be less available aggregate, but there still will be insurers looking to write in the region, and I'm sure there'll be reinsurers that will be willing to support a well thought out plan.
I was just going to say, I've only heard of one reinsurer who is trying to implement a sort of a regional escalation exclusion clause, and that was very much pushed back by certainly the reinsurance brokers, because to Dan's point, reinsurers have always been committed to the region. It's a hub of energy infrastructure. I still remain hugely enthusiastic about the region and the opportunities across the board, not just in terror, but where this country wants to go, where the region wants to go. I don't see reinsurers on the whole starting to put in exclusions, regional exclusions, because it would essentially make the product null and void. But absolutely, to echo Dan's point, you won't be able to pop out and buy 1.5 billion of PV, including war, for an airport. It'll go back to the sort of the good old days, without showing my age, of you might get 50 and 100 might be a push, but guess what? The pricing of 100 might make it a little less attractive. So it'll just absolutely bring that regional country ag down, the country ag specifically down, and then the individual locations. There will be definite caps on what people are willing to deploy, potentially by an industry sector rather than by a country. It might become, to Dan's point, a real pivot in underwriting rationale, and that is a moment in time rather than looking at a country and a region from having restrictions from reinsurers.
The market's not, certainly from what we've seen, absolutely not looking at pulling away whatsoever from the region, but more just adjusting those line sizes and managing their ags. I mean, the UAE, it was a huge ag deployment of SMT capacity historically. So certainly, I think markets are just going to take a bit more of a methodical, rationalized approach to just kind of scaling back their exposure rather than actually pulling themselves out the region full stop. So just echoing and agree with Sandy and Dan's comments.
The PV market has obviously grown and matured quite a bit in recent years. And I think about it as having a number of, if not turning points and punctuation marks, probably go back as far as certainly a very different scenario, but Chile in 2019, if that was when it was, pre-COVID anyway, strikes right civil commotion, but frankly, a big growth moment for the PV market. But it's still relatively young, evolving from its post 9/11 terrorism coverage focus. And then again, war risk is a very old line of business. It still feels like a market that's maturing, though. And this is a pretty broad question for all. But is this a defining moment in that evolution? And how does it compare to some of those previous inflection points, like we've talked about them earlier? I just did Chile, South Africa, Ukraine.
If you compare this conflict with what we saw in light of the Ukrainian-Russian piece, I'd say that Russia-Ukraine was the first big waking up of the market that it's had since kind of the post 9/11 era. And without sounding too sort of philosophical, but I think in a way, these really, really grave moments for the market actually stands the market in seriously in much better stead going forward. The more data, more loss information that comes through from these major events can actually render the market being more robust, the better understanding it has on these potential CAT events. I'd say that the rating model had to adjust pretty significantly after the Ukrainian conflict. I think it still has got a way to go, but I think certainly the market is in a much better place than it was at that point in time. And certainly I think is better equipped to be able to handle these losses. So we're going to certainly see a further adjustment, a further hardening of rates, just nature of line size being pulled back and capacity being withdrawn. But I think certainly it is maturing, but it's growing up pretty quickly. And I think it's in a better place than it was at that significant readjustment post-Ukrainian Russian fallout, as it were.
It will be a turning point, and we'll definitely see it for the region specifically. But insurers will be looking, I think Sandy mentioned it earlier, about the knock-on effects of what we'll see, whether it's further SRCC events, the likelihood of extremism happening in different parts of the world, whether that's a heightened risk of terrorism events, and then coupled with the losses that we've seen already, the market will have to adjust, and that's fine. That's what markets do. More information means that markets will have better insights into how to plan going forward. So I do expect there to be sort of a significant change, but it's probably going to still be probably a few more months until we really sort of nail down what the loss quantum is going to be, and then people will review it from there.
Just to add, one of the things I genuinely love about our marketplace is that it's not linear. We are not a line of business where we have the data, where we know that every September there's going to be the wind blowing and we can track the storm paths, and that life isn't linear. So to me, this is a fun dynamic to be working in, because you get to be reactive, you get to pivot, you get to constantly challenge, whether it's from a reinsurance pack, how are we going to define our appetite? How much do we want to take net? What is that black swan event that, we think we know we're prepared for and we're protected for, but then something happens that makes you pivot? So that's something that I really personally like about the business, is that, yes, it might be mature, but with that youthful market, you get the ability to really sort of think outside the box and redefine definitions on a regular basis. Which other line of business lets you do that? And then secondly to that, Dan and I have certainly grayed, can't put Cosmo in, he's still far too young, but the period between these events is shortening. I saw Dan the other day and we were laughing. We were like, what, we getting this stressed about, Russia-Ukraine? That felt like it was last month, and, sort of a bit of a tongue-in-cheek moment. But there was a period of time where there weren't losses. So people were saying, well, you've never had a terror loss. I've never had one in my career. And that drives rate down, and that drives the softening. Whereas now we go, God, hang on a minute. I remember Chile and the stress that caused. And then we've had to look at SRCC accumulation. And then it was, what are we doing in terms of writing it within a property class and a terror class? And you have to constantly pivot because you're moving around the world. You're talking to different clients, different purchases of the product. And I think that's what I love, is that we still get accused of being a young marketplace, but we still respond. And I think it's just going to cause that further hardening and compounding of the market, because people's memory now is much closer together of much more recent events. This isn't just regional. It's, as we said, Russia-Ukraine is still ongoing and doesn't feel like all that long ago. So I think that's the difference now.
There is a range of perils that is quite significant in there. They're all very different events. And certainly whenever I have these conversations, it seems to be a art versus science conversation sometimes. And I think a common argument is that you can't continue to grow a class sustainably without more science. And we do see all manner of weird and wonderful data being used, and some people building their own models from scratch, and other providers coming up with things that haven't been done before, whether it's SRCC modeling and that kind of thing. And that's, to Sandy's point, I think it's what makes this such an interesting part of the insurance business. Maybe stay with Sandy for a second, because talking about, so this is a defining moment, not so much just the PV market, but for the UAE, for Dubai, for the Gulf monarchies. Yeah, I mean, this event has surely shifted perceptions quite a great deal.
Yeah, and I have to say, having been on the ground the entire time, I have a very different perception to probably most of you out of region, especially in London, where it's been portrayed as if I'm sort of still on the Gaza Strip. And I think I have to say the UAE government have done an absolutely outstanding job of making its people feel safe. And so the irony is, despite living through a very surreal, unprecedented time, I have definitely never felt safer being here. The communication, say what you like, I'm definitely not being paid. I'm not an influencer by any means. But, when I look at what the Gulf state have done, despite the fact there were being ballistic missiles and drones sent at you every day, life carried on, and they made it that way. They made it safe. So I think there's two things. There's the perception on the ground and in region, and then there's the perception of the world outside of region, which is very sort of diametrically opposed. I think what it does do, though, is, if we're all honest, nobody ever thought you would see war coming into play, especially in Dubai. The sunshine holiday, Gulf state, it was there as the safe spot, that everyone would holiday to, go to. And, you didn't need to really buy more than S&T. You got PV a few years ago because the market was so soft and you could probably get it thrown in for free. And so I think that's that sort of shifting point. But certainly perception of risk is going to change hugely externally versus internally. I can't say for a minute it's not had moments when it's been unsettling. You don't want to be sitting in a war zone and getting an update about incoming missile alerts. But to say that I feel safe, I think is a really strong statement that I would like everyone internationally to take away, because that is also the real reality of being on the ground and living through the past 2 months of it.
There's some things to say I would probably add to that. Terrorism was also very rare as a risk within the UAE as well, and yet people did buy the coverage, whereas a comprehensive product like PV is more expensive, and a lot of people weren't buying it. And I think that's just a reflection of the way the world really works. It's how cheap is that product? You add them together, you come up with something more expensive, more comprehensive, and suddenly the buying rate goes down. And there is the geo in geopolitics. The UAE has not moved closer to Iran in 2026. It was always the same distance away. Strait of Hormuz was always on the doorstep. Let's talk about capacity and pricing. And also something we haven't really addressed, but I think it's a bit of an elephant in the room. Do we expect some exits from this market? It's happened before, even after Russia-Ukraine, there was one or two that left. And I think at the time, cost of reinsurance cited as one thing, and there not being enough premium at the time to justify it. And that seems eerily relevant to the situation we're in now. So yeah, we're going to see some exits, but also maybe some new entrants due to the spiking rates, some rebalancing of underwriting behaviors.
Let me get my crystal ball out. I mean, look, it's very hard for me to say without actually controlling, each individual market's own book and seeing, their volume and the premium they've got on their books. But certainly the numbers, which we don't need to keep reminding the audience of, but the numbers that are being spoken of are enormous. And if you look at some net lines that we think are being speculated of markets on some of the major losses, it's hard to see that actually some of the smaller books of business will struggle to survive the fallout. That being said, with Ukraine, we actually saw the polar opposite effect, actually, in light of the conflict, which actually the market hardened at a rate of knots and actually softened overnight. There were opportunistic players that saw higher rate environments and decided, actually, no, it's a good chance to go into the line of business and potentially try and make some money out of it. So will we see some markets folding? I couldn't speak on their behalf, of course. I think certainly I would struggle to see a couple of them not have quite serious looks at their PV books and see if it's actually going to be sustainable, just because of their premium volumes not correlating with or matching up to some of the losses that are expected. But certainly we could well see a couple of new players come into the market and actually seeing that heightened rate environment in the region as an opportunity to go and support the area. I think from a rating perspective, just across the board, we're already starting to see it. Again, as Dan and Sandy have alluded to as well, this is totally not just a regional specific issue or event. We are going to see the knock-on effect, as we have done with all major loss events. We're going to see the knock-on effect on rate in the US and the more benign territories, just because of the nature of the global book that PV books are. Everyone offsets those slightly more hostile territories with those hedges to their portfolios, really. So I think there are certainly some stern conversations happening at those smaller syndicates, which have the slightly smaller books, because certainly the numbers that are checking out will certainly look like they'll be outweighing some of their portfolios, and whether or not that becomes unsustainable, we'll see in the coming months.
I agree with what Cosmo said. I think it's difficult to know at this stage what will happen to market participants. We've been saying for a long time that there's overcapacity in the market, which has driven pricing down. Whether there's a realignment now, I think we'll just have to wait and see till later in the year.
Just to add to Dan's point, going back to what I was saying earlier, if I'm in year 2 of writing a portfolio with a gross written premium of 10 and a net of 5 versus Dan with a gross written premium of 10, but 10 years of profitable business banked, it's a very different discussion with your management as to what that looks like over a cycle. So it's going to be a very bespoke conversation for each insurer at a point of time, depending on their own reinsurance and their own net. So it's hopefully going to cause some capacity withdrawal, but then you don't want the new markets coming in to drive that price down when we're finally seeing rating hardening, which goes back to one of the questions about adequacy. Are we there yet? I still don't think we are, but until we have the full data sets by peril, by line of business, by region, only then can you really talk about technical rate adequacy, certainly from a Lloyd's perspective, would be my answer to that question.
We've talked a lot already about PV versus just standalone terror, S&T, but it's probably worth just ramming the point home. start with Cosmo and then go back to Sandy, I think, on this one. What does the event tell us about the importance of having comprehensive PV coverage, versus narrow S&T? Key lessons for clients and brokers.
I think so. I did a piece with you actually, David, literally a month or so ago. I think
we did. It's not that it hasn't aged. Your points are even more timely and prescient. The crystal ball must have been out on the table that day. It's just that what you said now was the time to buy because there was a great time to buy. And what we didn't know was the window was only open for another few months.
The fact of the matter is that at this moment of time, of course, the market is in a hard place, in that territory. I think certainly all it's kind of come to prove is that on the podcast I mentioned that basically at the time it was a soft market and it just really hammered home the importance of getting in before it got hot. And we always get asked the question, where is the value of the product? We haven't had ours tested in years. We had some clients, I mentioned one earlier, who had been buying for 10 years. The product had never been tested. And they ended up coming off non-renewing the program and decided it wasn't worth it. And lo and behold, we are now where we are, and they're looking at many, many, many multiples of what they were buying historically. I think brokers need to be making sure they're getting out there and educating clients that are unfamiliar on the product, making sure they're getting out and educating them in full about it. We have hammered home the point about not cutting corners with just buying standard terror coverage and actually making sure they're buying the full war exposure. And longevity in the market with the product will stand you in good stead for when the market gets into stiff positions like it is now and negotiations get tougher and you are renewing those programs. Then hopefully I can speak on Dan and Sandy's behalf, which is that the market will favour those long-standing clients that have been historic buyers who are familiar with the product. And so educate yourselves and Sandy, I think, don't look to cut corners up front because the losses down the line, the potential implications can certainly come back to bite you in the long term.
Yeah, I've written down education and willingness to lose. Again, you can't dictate to a client what their appetite is, but if they've been well educated and sufficiently educated by their broker as to the nuances of cover, and now there are enough worldwide examples that can be given of if you buy X, it will not respond to Y, then it's a client's willingness to lose, and the education they are getting from the broker is just going to be key going forward.
Well, kind of taking everything we said together, how should we think about the future shape of the PV market? We'll start with Dan, as Sandy and Cosmo just spoke. So the future shape of the PV market from here, is this a short shot or is it better to think of it as a structural shift in how the risk is priced, placed and understood globally?
I would say it's both. It's a short-term shock, but it probably have long-term ramifications. I would say capacity is still available, but in certain regions it's going to be significantly different and the terms and conditions will be tighter. But the market is still looking to provide capacity to clients. So it would, in my mind, remain a very important product to buy going forward.
I'd probably say the structural shift for me, just to give a different approach, is it's similar to Russia-Ukraine. It's changed the way of war. Having very targeted drone airborne attacks is different to the traditional lobby bomb blast with a 250-meter damage radius. And so it's having to change for us and our analysts. What kind of attack could you have? Because certainly if you have a sort of an airborne device targeting a specific generator that will cause a disproportionate amount of damage, what do we all know about the individual countries and their air defense systems? Because again, that's moving away from a previous, on the ground defensive or a way that you can defend a country. So I think the structural shift for me will be looking at how we look at the weapons of warfare going forward. That's my big takeaway right now.
And that concludes this episode. Many thanks for listening. Please do keep tuning in. There is, after all, no shortage of timely conversations to be had at the nexus between insurance and geopolitical risk. One last reminder for me to book your place for DWIC Connect in Istanbul on the 7th of July. Once again, thank you to my three wonderful featured guests, Cosmo Warne, Dan Callow and Sandy Warne. I've been your host, David Benyon. Production was by Peter McGill and my cousin Lawrence Durkin made the music.